Hello, everybody. Day 8. Jolene's been in Phoenix without me. The dog is angry. I discovered that the laundry and the dishes don't just magically get done, and I had to do it. It reminded me of my childhood when my parents would say, "Do your own damn laundry, clean the dishes." She'll be back tonight, so I'm looking forward to it. I tried to get the house a little cleaned up for her. So, what have I got for you today? Have we talked about this article? The stock market is not in a bubble. No fooling. I wrote this a week ago on April Fool's Day. Tell me in the chat, did we talk about this? Did we look at all this neat stuff, right? That the market's overvalued, but not horrifically overvalued. I should say the market, the SP 500. Ray Dalio, yeah, this is coming to mind. Ray Dalio said, look, it's not really a bubble yet. Could get there, but it's not yet. All right. There's been a lot of comments on this article, and they just keep trickling in. So apparently people are reading it. Anyhow, let's go back to what you're all waiting for, which is the $1 million retirement portfolio. We're not going to talk about a lot of the holdings. I do have the dividend stock, the punch card dividend stocks, and the Kirk's a Grandpa stocks with some revisions that will be released over the next couple of days. And I really want to remind you that I'm still waiting for a dip here in the second quarter. The bifurcation continues to happen. Last week I mentioned some companies that we had sold, and one of them bought back. Another one looks like it might be time to buy back. I put on the growth stock list was MP Materials, and it jumped today, a week after I said, maybe we should look at it. So we'll look for it to jitterbug and try to get it below 15 probably. But there's a lot out there. And selling puts, which is going to be a topic today since Mondays are sort of for that, I think is a good strategy as part of recycling your money. So let's talk about this $1 million retirement portfolio. First of all, there are a lot of ways to invest. Growth, dividends, you can trade, you can buy and hold. And I just don't think of investing in any of those ways. I know that people want to say, oh, I belong to a high dividend service, or I belong to an Elliott Wave service, or I belong to this service or that service. I do it this way, I do it that way. I hope everybody makes money, but I know that 80%ish of the people do not beat the index, which is why Buffett tells people just to index, because they're shooting themselves in their foot. But if you beat the index, you are a top 1/5 investor. And I have, over rolling periods, kicked shit out of the index almost 30 years now. I've had a couple of down periods, a couple of back-to-back bad years. But for the most part, every 3 and 5 year period, I seem to beat it. Sometimes by a little, sometimes by a lot, but almost always on a risk adjusted basis, because I like to hold a lot of cash and recycle it. We'll talk about that in just a minute. So, my goal is to try to triple my money every 5 years. It hasn't always happened, but by aiming for that bogey, that 20+% per year average, which would pretty much require you to be perfect to get there, we can still do excellent if we land somewhere in the teens. If we all averaged in the teens, we'd be crushing the market, which is averaged 10-ish%, maybe 11% with dividends for an extremely long period of time. But there are decades, 3 of them in the last 100 years, where the stock market only averaged a very low single-digit return, basically the dividend yield. And I think we are a year or two away from one of those 10-year periods, or maybe a little less, one of those extended periods where the stock market, for S&P 500 investors anyway, for indexers and closet indexers anyway, that they're only going to average a single-digit return, and probably a low single-digit return. And many of them will lose money because they will panic sell volatility or bottom. That's the way that it always happens. I haven't seen any evidence that it won't happen again, but I think that there is actually another thing to keep in mind, and I've mentioned this 2.5 years ago. I talked about this, or it might have been 3.5 years ago. Don't even remember anymore. When I wrote that first article about the millennials being the most important money in the market. I think that the millennials are better investors than the boomers in general. I think they're more systematic, more mathy, probably more arrogant, but better anyway. And I think that the millennials are going to continue to outperform the boomers on performance. And that will be part of the shift in wealth, along with millennials charging for their services and asking for more money at work that the boomers didn't really do, and inheritance. just better returns in the market. So I think the millennials will do better in the markets. They're going to inherit, and they demand higher wages. So the shift in wealth is going to be profound, and I'm positioning myself for it. I still haven't completely given up hope of owning the Brewers someday. You know the scenario I think that could make it happen. In fact, at poker the other night, I had busted out just before the final table. I was talking to a guy at the end, 70-ish, retiree. He asked me what I did, and he was like, so everybody kind of pays attention to what you say and do. I go, yeah, it took a very long time and a lot of mistakes. And he goes, well, that's the way it is. And so we exchanged stories, and it got to politics for a minute because he said something, and I said, well, I don't know that I see it that way. Here's what I think. And, turned it into a joke. I said, I have lots of Republican friends, and what I don't have is a lot of MAGA friends. And I call it MAGA because I know it's MAGA, but I like calling it MAGA since they like to say Biden instead of Biden. So screw them. And I said to him, I said, I understand why people voted for Trump. I get it. I wrote a whole article about it in 2017, and nobody who voted for Trump ever said it was wrong. So if you want to see that article, go to bluemountassetmanagement.com, and you can read it. You can tell me if you think that I was spot on or spot off. In fact, I can probably even pull it up for you here on the interwebs. There you go. Challenges and opportunities for the Trump presidency. And go ahead and read this, because I think it ended up being a pretty good piece. You have to register for the website. In any case, my theory about if Trump wins. If Trump wins, we get a spike and a crash, and they'll both probably be pretty epic. So I think there'd be a lot of money for making a great trade. Now, presuming Biden or Gavin Newsom win, which I think is actually the more likely scenarios, then we plod through that transition on clean energy and the boomer retirement. And it'll be much more systematic, the approach, a lot less tradey, but still there will be a transition period, which is angst causing for a lot of people and hard to navigate when you're asked to look 2 or 3 or 4 or 5 years forward when you're living in the present and looking a year or 2 or 3 back. Because our experience, especially our most recent experience, is what sticks in people's mind. I talk about the financial crisis from time to time, and it's mind-boggling to me that the millennials listen and they're like, wow, I just didn't know. I was too young. And I explain the psychology that I think that the millennials have, in their young years, in their 20-ish years, maybe late teens. 9/11 happens and the world changes. I mean, really changes. It was, and I remember when Reagan got shot, principal coming on. And I know some of you remember when Kennedy got shot. Remember when the space shuttle blew up. But 9/11, man. And that's why we should keep in mind how early we are in the process beyond October 7th for the Jewish community. Think about how long it took you to transition after 9/11. How do I think about travel now? How do I think about terrorism and immigration, everything else? And all these things play into your investment portfolio. They really do. I wouldn't talk about them otherwise. Because mass psychology moves prices. So the millennials started off seeing the world change when they were young and idealistic, which really isn't fair. You're supposed to be wearing your idealism on your sleeve when you're in your 20s, as far as I'm concerned. Because a handful of folks who pursue that idealism can change the world. And I think that was partially taken away from them. Then they get out of college, and the financial crisis happens because of ridiculously bad financial management in the financial institutions and the destruction of the regulatory framework, which actually began with that last bill, compromise bill, that Bill Clinton passed. It was a compromise deal to save the parks in the country and a lot of the untouched land in return for starting to chip away at financial regulation, which really accelerated under Bush, George W. Massive deregulation of the financial markets, spike in hot money, speculation and leverage. Then we got the financial crisis, right when the millennials were looking for a job, their first jobs, got out of college with debt that they shouldn't really have in the first place. So now they've had their idealism chipped at or really whacked in the head. And then they couldn't start families in their 20s because of the financial crisis that they did not cause. And then they catch grief for a decade because they're not buying houses and starting families and giving the boomers grandkids. So I understand millennial angst. I understand their passive aggressiveness, which a millennial friend to me described in detail after a Milwaukee Brewers baseball game one night, Rob, and I see how they have traded, how they've learned to invest. I understand their skepticism and cynicism because of what happened younger years of their life when they were in their 20s and into their 30s. Now I'm seeing friends of mine who are in their mid to late 30s finally having kids. And I think that their approach to investing, steeped in skepticism and cynicism, is one of the things driving Bitcoin. And is a way for them to hold on to some of their idealism, which is why you see the big investments in clean energy that spiked up a few years ago that have crashed lately on EV pessimism and solar pessimism, which is really just a capex cycle to get everything built up, see the technology improve, the manufacturing processes improve before an inflection point, which I have consistently said since CES of 2020 would come in 2026 and or 2027. And we seem to be about a year behind that, although Elon Musk had some interesting things to say today. So I'll just stick with 2027. We'll throw out the 2026 part. Maybe that's the recession year, in which case you will want to back up the truck on clean energy and clean energy related things. So that's the backdrop to how I'm building portfolios, even for retirees who may not even have $1 million yet, but sure would like to get there. They have $300 or $500 or $700,000, a lot of them. And they understand that if they're going to live to be 100, if I have a grandmother whose 95th birthday party is this coming Sunday and an uncle who just turned 90 last year and be 91 in a few weeks, I think his birthday is on Jolene's birthday, actually. Well, if there's people in their 90s now, people in their 60s and 70s really ought to be thinking, I should have enough money to get into my 90s, or maybe even 100 or 110. If I take care of myself, I'm thinking I should crack 100. I'm going to get on that weather show. I see that's an old reference. I don't even know if the millennials listening know what the hell I just said. So you've been staring at my screen saying, what does he mean model portfolios are shit? So let's talk about that. People buy investment letters to save a buck for the most part, right? They understand that most financial planners aren't great investors. They come to understand that because there is no training for the certified financial planners that has anything to do with investing. It's all other stuff, taxes and, financing education and how to sell more products. Financial planners have no training on investing. If you find one that's a good investor, it's rare. They are the 1 in 5 that's a good investor. The other 4 out of 5 aren't any better than you, and probably worse because they have to employ cover their ass methods and hide in the crowd versus trying to tell you a good way to invest, even if they knew, which most of them don't. So for me to give you a model portfolio and for me to say model portfolios are shit, stop asking. I'm telling you that I can't give you a model portfolio that has any legitimacy because I don't know who you are. I don't know your financial circumstances. I don't know your time frame. I don't know your goals. I don't know how well you sleep at night through volatility. So quit asking for a model portfolio and stop looking for them. Because if you find one, I'm telling you, it is shit. I have never in 30 years seen a model portfolio that I could just plug into. Never, not one time. I want a shortcut too. I want to save money too. I want to save time too. But if you want to be a good investor, stop looking for a shortcut. And if you don't have the time to invest on your own, just freaking hire me or somebody like me. You got a 1 in 5 chance of finding somebody like me, maybe a little less. I like to think 1 in 10 or 1 in 20 on my really arrogant days, 1 in 50. In any case, there's a more technical level of it too. The reason technically model portfolios fail is because they do not take into account price movement. We have seen downward momentum drop stocks 30, 50, 70, 90% to ridiculously undervalued prices, but it just kept going down for a long time. Talk about Spire Global in a minute. Company's clearly worth a lot more than it's trading for and way more than what it got to. But when investors hate something, they start to sell, and something falls out of the institutional investor range. Because remember, institutional investors have rules. They're dumb rules, but they got them. They're mostly dumb rules. It's all about cover your ass for them. That's why Warren Buffett can kick the crap out of everybody else because he doesn't have to follow those dumb rules, the charters. And he doesn't have to worry about regulators. Heck, he practically owns the regulators at this point. Guy like me, I have to listen to the regulators. Even if they're not talking much sense, they're the boss. So me managing other people's money, I have to be careful not to get blown up. because somebody complains about a stock that dropped 70 or 80% that I want to buy more of. And they're like, no, you're fired and I'm selling at the bottom and I'm going to complain. It happened once, right? The story of Exact Sciences for me. I was buying it at $1.50 for 7 years. I was buying that as a single digit stock. Then it tripled in a year. I had options on because I got a catalyst trade in front of the FDA and Medicare. I knew what was coming. I could read. I could look at a calendar and understand that September was a little bit after April. Make an option trade, 10x my money. Took a little over 7 years to 10x my money on Exact Sciences. I got into the 30s. I closed all my options, locked in all those profits, sold half my stock. Stock dropped to 20. I started to buy it again. Had a poker friend say, hey, she's my age, said, hey, I have 150 grand and I want to retire when I'm 59. And I was like, well, so that means that in 15 years, she wanted to get her 150 grand over $1 million. It's doable, but you have to be pretty equity focused and you got to invest in small caps, make some good sector bets. So we did that. We invested in oil, which chopped along during that time range. And we put a pretty big, a meta-sized position on Exact Sciences. Well, it dropped 20 to 12 to 6. She fired me when it got to 6. A month after that, the CEO of the company bought the stock after it had been dropping down to 5, and I loaded up. I backed up the truck. About the same time I got the arbitration letter. Fought that for a year and a half. If my lawyer had been working a little harder, I would have fought it another 6 months because the stock shot up that 6 months later. So I settled something that 6 months later I wouldn't have had to settle, because if there's no damages, you don't have to settle. If I had waited 6 months to settle that arbitration, I had paid zero and it would have been gotten thrown out. And by the time everything got confirmed, they all saw it happening, to the point where her attorney, I bumped into him in a bar 2 years later. He goes, yeah, probably didn't need to move that fast on that one, but I was getting pushed. He's like, I understand. I said, don't worry about it. I made another $1 million. So I don't care. I wrote her a check for 40 grand. If she just kept that stock and bought more when I told her to, she would have got to $1 million. But no, she complained, got 40 grand instead. And so when you think about investing, think about the time that you're in something. Average American investor sells their portfolio every single year. Average holding period on a stock is 10 months. That is ridiculously stupid. It's off the charts stupid. It's a combination of ignorance, undereducation, which is different, lack of experience, and extreme emotionality. Everybody could use a little bit more Spock, by the way. I'm watching Star Trek Discovery right now, so you might get another Star Trek reference. So the reason that model portfolios fail, besides the fact that they have nothing to do with you, is that the price movements in most equities happen overnight, and sometimes you get huge momentum to the downside or upside. Fail with model portfolios to say, well, buy this below this certain price. Because a lot of times when a stock is falling, it just keeps falling, and you'll get way below that price, which is why we scale in at very wide price points, not 3 and 5 and even 10% dips. A dip to me is 20% or more, right? A bear market. And sometimes it's 30, 50, 70%, 80%. In the case of Spire Global, 90%. And we bottom ticked Spire Global last fall to the point where everybody almost tripled their money for a hot minute. And if you sold on the day that I said to trim, then bought back a week later after the secondary, it ended up being pretty awesome. So model portfolios are shit. They just are. Better way to invest is to recycle your cash. What do I mean by that? I mean that if you are an option seller and a dividend collector and an opportunistic trimmer of stocks, you will always have money to invest. You might take a profit over there, then reinvest it in a dip over there. Or, much more systematically, you just every month sell cash secured puts once or twice a month, so that your cash in your money market that's collecting interest already also collects a premium on a stock that you'd love to own if it went a few bucks cheaper. In the case of small caps, a few quarters cheaper. So the reason I sell options is because every month something's expiring and I get to sell something else. Money in, money in, money in. Now, if you are working, the money in for you is your wages. Your biggest investment is a 401k, and hopefully you have a Roth IRA and then a brokerage account, right? The more you can save, the better you can do. I understand that it's hard to save 15 to 20% of your income. It's what you should be doing. 10% is a silly old rule that we used to tell people because we knew that they were saving 5. The reality is that Americans who save about 20% of their income are the ones that become millionaires. It's just the way that it is. And if you have a higher income, you become a bigger millionaire. But if you're average income to, if you're in the 60s for income, you can get to millionaire status, but you have to learn to live on 50. It's not easy, which is why when I say that wage inflation is good, that's what I mean. Wage inflation is very, very good. Interestingly, Elon Musk had a comment about the Boeing CEO and his 30-something million dollar bonus on the way out. And he's just like, yeah, it doesn't make any sense. I think he just had some smug one-word reply or something, somebody else's post. But how often have I told you that the big skim at the top is the big problem? It's not that your neighbor makes an extra $5 an hour because they joined a union. It's because you got guys at Boeing who have shit flying off of airplanes getting $30 million bonuses. I can feel myself getting worked up a little bit on that. What I was going to say is that motherfucker should be in jail, but I won't say that. So it's the big skim that you should be concerned about, not somebody making 15 or 20 bucks an hour that used to make 12 or 10. So as an investor, as you recycle your money, as you see, I'm almost done with this article, by selling options and trimming opportunistically, you can do pretty well. And what we have learned, I got this table from Seth Golden over at Phenom Group, who borrowed it from another good Italian boy at Dollars and Data, which is a kind of a subsidiary website of Ritholtz Wealth Management. It shows the Chicken Littles who are chronically in cash do horrible. This is a 20-year time period. Chronically in cash. I'm scared of everything. I just want to earn my 3%. I had somebody tell me that recently. Sold a bunch of stuff in his 401k plan. It was a mistake. He fixed it. This is bad timing. This is people who don't panic sell, but they try to trade. They trail, just dollar cost averaging into the money, or just invest whenever you have money, right? If you're dollar cost averaging, you have a pretty good return. Now, most of the people who engage bad timing methods actually end up kind of in between these two numbers, because those people are prone to abandoning their system, which is mediocre to begin with, and panic selling bottoms. And then this is perfect timing. So people would have earned over those 20 years with perfect timing. So clearly your goal should be to be mostly invested most of the time, getting invested most of the time when you're not, and do the best you can to get between the dollar cost average number and the perfection number, which you can't get. But I will tell you, by selling options is the only thing I've ever found that overcomes the gap to perfection. I actually have done this well over that time frame, but it wasn't because I made perfect investments and bought all the perfect bottoms. It was because I just kept selling options and collecting premium, so I had more money to invest. If you invest more money, you'll end up with more money. So learn how to sell options. Here's the cycle. Sell the cash secured put. Some of those contracts will expire and you just get to sell another put and collect more premium. Sometimes the shares get assigned to you and there's a temptation to immediately sell covered calls. No, wait till it goes up a bit. You sold that put for a reason because you wanted that stock. Now, if it turns out you're wrong about the stock, just get rid of the stock. Sometimes that happens. Sometimes you're not on track. Catch that? That's pretty clever of me. And then on those momentum rallies that get a stock to become both overbought and overvalued, go ahead and sell some shares or have them called away. Rinse, repeat. Rinse, repeat is one of my favorite phrases. I know it replies to girls washing their hair, but it works in investing too. Rinse, repeat. Woo! So if you do not sell options yet, I'm putting the links in here. They're also in the resources tab in the getting started area. Learning cash secured put selling, learning covered call selling, and then read my other option pieces. And I'm in the process of updating everything because I'm doing a major website overhaul over at Fundamental Trends that has to do with launching the service in both Australia and Japan in the next quarter or two. So what am I holding right now? I'm just going to show you the full position and help you understand that they're not all dividend positions. I know retirees think, well, I should be in dividends. No, you should be in good companies. You should be looking for total return. And if you're an option seller, that opens up the entire universe of growth stocks, which is where most of the money gets made. Always has been, always will be. People, but what about value? Value has always been cyclical. Growth has always been forever. All the giant companies started small and grew to be big. It's a universal truth. There is no exception to that. So the biggest holding I have, even in millionaire retiree portfolios, is a Metis. It's actually between a double and triple position. A full position for a stock for me is 3 to 5%. For ETFs, it's a little bit bigger. Talk about that in a second. But I've accumulated the position on a Metis by selling puts, and on a couple occasions they got put to me. Then last May, we bought a boatload when the stock was under 2. kind of been breaking even on the call buying because it's hard. That requires good timing and luck. But if you just buy the big dips and a Meta's drop from 20 to 2, you can make a lot of money. Be a bit of a vulture. Think like a private equity firm. What companies are the private equity firms really looking at right now? Paramount and Warner Brothers. If Apollo and KKR and other private equity firms are looking at companies like that, you should look at companies like that because they're vultures. The vultures just bought one of the companies I'm going to show you in a second. Invest where the vultures are. At a minimum, they're going to pick the meat off the bone. Sometimes you're going to help that company fly back higher. Usually it's pick the meat off the bones, but every now and then, one of those private equity companies really takes off. In fact, I think it's different today than it was in the past when it was all bone picking. Private equity firms in the last 3-4 years in particular, but really starting after the financial crisis, have been more growth investors than strip the meat off the bones investors. They've been getting in things early, growing them, and then spinning them off to the public or just selling them outright. So Metis is a company that I think, just based on the value of their refining assets, going to get much, much more expensive. There's actually a CARB meeting this afternoon, and I'm going to listen in on. And then another one, more important one, the LCFS meeting is in 2 days on the 10th. So you can go ahead and register for that if you want. And I might even send out a message and you can watch it on my Zoom channel. So Metis is my biggest position, followed by Bitcoin, which we bottom ticked. We bought that in November, Q4 of 2022, after we had bought it after COVID. Then we sold it at the end of 2021. Then we bought it back at the end of 2022. And this time we have the benefit of more information on Bitcoin. We can see that it is becoming a part of the international currency basket. We can see that. It's not speculative. It's happening, which means that Bitcoin is a 5 to 10 bagger from here minimum. And it might be a 30 or 100 bagger. We'll see. Depends on if people in certain countries start buying their pizza with it. I think it's mainly going to be for sovereign wealth funds and corporate balance sheets and national balance sheets as a hedge against the dollar getting too strong, not too weak, and everything else getting too weak. So there's going to be a lot of currency collapses in the next decade or so, but not the dollar. The United States economy isn't Goldilocks, Goliath. So IBIT is growing to a pretty big position for me. ETF positions, a full position is 4 to 8% or even 5 to 10%. Stock positions are smaller. Why is that? Diversification, right? I'm actually treating Bitcoin as a stock position. So I might even change the wording of this. Might explain it out a little bit more. Think of Bitcoin as a stock holding. Do you want it to be a full position, a double position, a triple position? I'm pretty comfortable having Bitcoin being an eighth of my portfolio, actually being an eighth of client portfolios. It's a quarter of my portfolio. Spire Global, bought it at $7. It dropped under $1, right? Split adjusted, Spire Global would have to get to like 70 to match its IPO price. It's 12 or 13 right now. It got to 18 recently, and they did a secondary offering. And we just happened to sell like a day or two before the secondary got announced. And then a day or two after, we could buy in the 12s, might be in the 11s right now. But the secondary was at $14 a share to institutional investors. And they used it to mostly pay down their debt. They cut their debt in roughly half, saving them all kinds of money in interest as they became profitable, or as they're becoming profitable by different measures. EBITDA, free cash flow, GAAP. This is a stock that at some point I'll sell covered calls on and trim. I think the stock gets to 50 to 60 next 4 or 5 years. So I'm not in a hurry to sell calls or trim. But if we get a spike, one of those things that look wrong on a chart, I can sell some covered calls 2 or 3 months out. Then when the pullback or the flattening comes, those calls probably just expire. If it gets called away for a profit, there's worse problems to have. Heron Therapeutics, another growth company. I don't know how big this company can get. I have a really low 5-year target, I think. I think they might blow through it. Why? So they have a treatment to help reduce or almost eliminate the use of OxyContin and, narcotics post-op. Settlement for Purdue Pharma back in 2020 was $8 billion. That was the settlement. The market is way bigger than that. This company is valued at whatever it is, $1 billion. I mean, I don't even remember what they're valued at. They're dirt cheap. Let's find out. $400 million. And the company that got sued for pushing narcotics just had a fine of $8 billion. If this company gets as big as the fine for Purdue Pharma, it's a 40 bagger. I don't know what the upside is. I think there's catalyst coming in the form of legislation. I think at some point a court is going to stick it to a doctor. I think there are all sorts of catalysts coming for this, and there's nobody really close on competing with them yet. I hope they don't get bought out cheap. If I were a big pharma company, I would be offering to buy this company at $10 a share and giving everybody in management 8-figure bonuses, bribing them to sell the company. I'd be going total zuck on them. Okay, you want a dividend stock? I'll give you a dividend stock. New York Community Bank Corp. But they just crashed, man. Exactly. New York Community Bank Corp looks to me the way that U.S. Bank Corp did in the 1990s. Take a look at the chart for U.S. Bank Corp, and you will see it was a few bucks a share back then. It's been a 20 bagger. Now it's choppy. Probably can't grow much anymore. So I've been buying this stock and selling cash secured puts into May at $3, $3.50, and $4. Why those three different strike prices? Because I want the stock, some of it, to get put to me. So the $4 ones are just a way of having bought it at a discount. I believe my net cost on those will be $3.50. If the 350s get put to me, my net cost is like $3.10. If the threes get put to me, my net cost like $2.70 or something. Right now, my cost basis is like $3.50, $3.60. Company might need another few $100 million. Who cares? The people who got involved, including Steve Mnuchin, have the money, have the connections, and more importantly, New York Community Bank Corp, which I've showed before, has a ridiculously good footprint. At the moment, they pay about a 5%, 6% dividend. If I didn't put the name on here and you didn't have a bias because of what just happened a few months ago, if I just said to you, I found a stock in the banking sector paying 5 or 6%, and it could go 10 to 20 times bigger based on their business operations and their finances, would you want to buy it? If I say New York Community Bank Corp, but they just went down. So when you're supposed to buy it, it's on sale. So I haven't got this all written out, but here are the half position. Ford, which has been a full position, but I trimmed it. I've traded it pretty well. Ebb and flow trading. I don't put all those trades out there because most of you won't follow along. If you want a swing trade, you know where to go. But Ford is one that I have very regularly sold cash secured puts on, and I'm going to sell more soon. Now, if the market doesn't dip like I think, then I'll just have to wait for the dip that I didn't think was coming that does come, right? Right. Innovative Industrial. We bought it when it had a 9% dividend. Stock's up $20 a share. I trimmed a little at like 105 or something. I'm just going to sell some puts or buy it back when it dips under 100. I don't know. I feel I have seller's remorse on this one, but I think we're probably a year out on marijuana legislation. I don't think it can happen before the election. Permian Resources. It's been a full position. I trimmed it back. Actually sold some cover calls and got some called away. Gonna sell more cash secured puts. Kind of in line with the article last week about XLE. It's a cyclical trade in a secular trend that's working against it. So the cyclical trade here for Permian Resources is bullish, but the secular trade for all the oil and gas stocks is bearish, except for the ones that are going to participate in the Inflation Reduction Act tax credits for bringing down carbon, like Occidental, which at the moment I only have a starter in, and I need to build that up. But how have we made money on that one? We just kept selling options. For those of you who are just like, I don't want to do that, the numbers are huge. Our option income every year has been double digit, way more than high yield stocks that carry more risk. By selling options, you can invest in better companies and not have to try to get a 7 or 8% dividend. It probably offers no growth, except in rare circumstances like Innovative Industrial. And usually the high dividend stocks don't usually have the greatest balance sheets either. So mediocre balance sheets are worse in most cases because they're straining to pay those big dividends to buy shareholder loyalty, which at some point they won't be able to afford. They'll cut the dividend, the stock price will fall. You've seen it 1,000 times. There must be underlying growth at every company. If there's not, you're screwed. Take a look at the gold stocks. Take a look at the cycle on Newmont Mining. 20 to 60 back to 30. Why? Why didn't it just always go up? It's gold. There are easy answers if you care to hear them. Block Square was a full position. I trimmed it back. Warner Brothers Discovery, they tricked me. They did. Them and Paramount tricked me. The big skim at those two companies is so big that they are sucking the lifeblood out of those companies. Zaslav at Warner Brothers Discovery cuts the debt, takes a bonus. Cuts the debt, takes a bonus. The physical assets, meaning their libraries and their studios, are worth double, at least, probably triple what their share prices are. And then you have all the other assets, TV stations and whatnot. But they run up these big debts, and they ran up big debts, chasing streaming rather than having a good plan, overpaying the help producing too much content, and just really being shitty stewards of capital. So my strategy for Warner Brothers and Paramount, and I have a covered call sold on Paramount at my cost basis. So I'm not too underwater on Paramount, about $3. Warner, I'm down 50. We'll see what happens with the Paramount deal if Ellison's kid ends up buying it. If he does, and then he can find a way of using that as an aggregation tool, I think that Paramount Global as a regular company could do very well. There'll be some dilution on the front end, which is why the stock's getting beat up again. But I think the future looks really good. So you can look back over the last year and go, it's a shit stock. Or you can go, okay, are they fixing things? I think the answer is yes, because everybody's motivated to have a higher share price if that's what they go with if Redstone sells. And I think with Paramount Global off the market, but not getting bought by another media company, right? Not getting bought by Apple or YouTube. I mean, I've been pounding on Tim Apple to buy Paramount. He doesn't return my message. So then you have Warner Brothers, who seems like should get bought by Comcast or Apple or YouTube. But Zaslav sucks so much money out of it that he'll fight it. So he hides behind the idea that he's doing a good job, and it's okay. But he gets paid 10 times more than what he should be getting paid. You shouldn't make $1 billion, which is what he might end up making over time, on a stock that's lost 50% under your watch, right? Big skim is real, folks. Again, don't piss and moan about your neighbor getting a raise because they joined a union and, they threatened to strike. People in the UAW still barely make above the average U.S. wage. They have to work overtime to really beat it. I mean, like 60 to 80 grand plus benefit. That's good. That's not special. AST Space Mobile, I think that we are at the point of maximum pessimism. I've had puts put to me and I've bought on the dips. My average cost basis is about $4.50. I'd have to look, $4.50 minus some premium. So I'm probably into it for $4 a share. It's in the twos. I'm probably going to add to it. I don't even think I'm going to sell cash secured puts this time. I think I'm just going to buy shares and bring it up to a full position. I'm only waiting to see if there's any more delays on the launches. Those launches look like they're going to go off this year. Then I'm in, because once they are supporting AT&T's emergency network, that's it. They have recurring revenue forever. Black Sky probably is also at the point of max pessimism along with Planet Labs, but I already have enough in my basket there. If you don't own Black Sky and Planet Labs, you could probably, get a starter and sell some puts, or just sell the puts, do a spread like I did for New York Community Bank Corp, right? Sell a couple different puts or 3 different puts. Some of them are more likely to get put to you. Others are less likely to get put to you. Collect all that premium, end up with a little position. Why do you want to own those? Recurring revenue. Planet Labs is in bed with Google and Palantir. Black Sky is in bed with the government and Palantir. So there's that. Spire Global has a unique network. It listens. It doesn't look. So that means clouds don't matter to it. Kind of a big deal. They're number one for the shipping industry for satellite. And then finally, Unity, which is an AR, VR, and video game play for development. They have a lot to do with Apple, which on some days can be good, some days can be bad. And Facebook is looking like more of a big deal for their future prospects. Unity operates in a duopoly in that space with Roblox, and I think they're both going to do well. But I like Unity better because of the structure of their business, comparatively speaking, and a strategic acquisition that they made a few years ago. And I think that's just playing out. But people don't understand because they don't see it in front of them. If you're not playing VR video games, you don't understand it. But if you were a skilled tradesman in the field or a surgeon, augmented reality is coming. It's coming fast in medicine and in industry and in the skilled trades. And that's going to be a lot of recurring revenue. And we are in batting practice. We're not even in the first inning. So Unity is another one that could be a 10 to 20 to 30 bagger because they are an asset-light company that is going to see rapidly increasing revenues, kind of like Palantir is in the process of seeing. The difference is Palantir was never really cheap. Unity is cheap. Somebody asked, should we be selling puts on Palantir? No, I've said that I want Palantir to get to about 20 before I sell puts or buy it. That 18 to 20 range is what I'm looking for. I just wrote about that the other day. Patience. You don't always have to be doing something. The money is made in the waiting. Just like in poker, you wait for better cards. In baseball, you wait for a better pitch. Here, we're in baseball season now. Here's the baseball analogy that Buffett uses. Imagine you were playing baseball and you could see as many pitches as you wanted without striking out. You can only strike out when you swing. There's no called strikes. Think that way. You don't need to do something every week. Plan, learn, have a strategy. If you're not a option seller right now, take the time to learn. Do the reading. It's not that much. Do the practice trading, right, in a paper portfolio. Then finally make your first option sell. And then watch it. Watch it from when you sell it to when it expires or gets exercised. And then go, oh, then the next cycle, do 2 or 3. And watch it and go, okay, I'm getting it. You can become a very good option seller in about 6 months. And it will add generally a double-digit percentage to your annual income. 10, 12, 15, sometimes 20 points a year. Why would you ever buy a shit stock with a big yield when you can buy a great company and still get the yield by selling the option, right? All right. That was a long call. I'm going to have to edit this in 2 blocks. All right. Have a great week. You have about 45 minutes to the eclipse. Go get one of those pieces of paper and, do whatever it is you have to do. I'm just going to look straight at it and see if my eyes burn out. But, yeah, we have an eclipse in about 45 minutes. Get out there. All right. Have a good one.